Uh, Welcome back to another session. This one's on cybersecurity disclosures in Australia. So first up, we will have, before that, my name is Mikhail. I'm a graduate at the AASB, and I will be emceeing this session. And with that, first up, we have Professor Dean Hanlon, who's going to give us a presentation. Dean is a AASB board member and a professor at RMIT, and he brings over 25 years of experience in academia with extensive research in financial reporting, taxation, and corporate governance. Today, he'll share his insights into cybersecurity disclosures, practices, and their implications for policy and reporting. Please join me in welcoming Dean.
Thanks, Mikhail, and good afternoon, everyone. Firstly, I just want to thank the AASB for the opportunity to present at this year's research forum. In terms of what I'll be looking at today, as the title suggests, this presentation will focus on cybersecurity risk disclosure practices as they currently exist, by looking at what the current risk disclosure practices are of Australian companies, and then engaging with stakeholders to identify opportunities for improvement to move towards best practice disclosures. I want to acknowledge the research funding of Chartered Accountants Australia and New Zealand, and also acknowledge my co-author, Dr. Prabhashi Damasiri of RMIT University, and also the research assistants of Anne Lee, who I think is in the audience today. Now, I've already realised that I've got too many slides given the time constraints, so I'm just going to highlight some of the key ones. So in terms of answering our research questions and achieving our research objective, we adopt a mixed methods approach, where firstly we undertake content analysis of cybersecurity disclosures in the annual reports of ASX-listed companies, just to get an understanding of what current cybersecurity disclosure practices are. And such content analysis involves us looking at the prevalence, the location, the nature and the quality of those disclosures. Then in phase 2 of our research, which is still ongoing, we conduct semi-structured interviews with investors and cybersecurity specialists, just to assess how cybersecurity disclosures could best meet information needs. This approach enables us to then identify what best practice might look like and help inform our recommendations. So I guess the final step of our research is to look at what's currently being done, take on board the information that's been provided by key stakeholders, and develop recommendations to facilitate a shift in cybersecurity disclosures to best practice. Next few slides, we'll look at our content analysis. So the first stage of our research. So this involves looking at the current state of cybersecurity disclosures by ASX-listed companies. And as part of this research phase, we did the following. Our sample was limited to the top 500 ASX-listed companies based on market cap as at 30th of June 2022 and 2023. And what I've got a table up there, which let's hope this clicker works. So this is the industry distribution of the sample companies across both years based on the GICS classification scheme. And you can see that from our sample companies, it's the materials industry which is most represented, and the utilities being least represented, but all 11 industries in the GICS classification code have been represented. For each of the sample companies that we've identified in the ASX top 500, we download their annual reports. While that was going on, we also developed a glossary of cyber-related words or terms informed by prior literature. Our glossary contains 38 distinct words, and any words which sort of a derivative were treated as the same word. So, for example, data breach or breaches were just treated as the same word. So in the report itself, there's an appendix which contains a list of those words, but I'm happy to provide them to anyone who's interested. And then we used Python. I didn't, I'm too old to use Python, but a research assistant used Python to undertake a textual analysis of the annual reports and extracting the relevant disclosures that contain at least one reference to a cyber-related word from our glossary. So the next few slides will provide some of the key findings from our content analysis. Colours aren't great, sorry about that. But we've got two pie charts here. So this first main finding relates to the proportion of sample companies whose annual reports contain cybersecurity disclosures. 2022 on the left and 2023 on the right. And as you can see, in 2022, 2/3 of the ASX top 500 disclosed cyber-related information in their annual reports. In 2023, encouragingly, this increased to 71.4%, but still 28.6% of the ASX top 500 in 2023 didn't disclose any information in their annual reports relating to cybersecurity, perhaps indicating a lack of awareness of the importance of cybersecurity to their organisation. We also did some size analysis, as you can see under each of the pie charts, where we split the top 500 into the top 100, the middle 200, and then the bottom 200. And those percentages reflect the proportion of those sample companies that did not disclose any cyber-related information in their annual reports. And so while the top 100, it's only 3% in 2022 and 4% in 2023 that did not provide any cyber-related information, you can see that there is variation in size, particularly when we look at the bottom 200, where across both years, nearly half of the bottom 200 of the top 500 did not disclose any cyber-related information in their annual reports. This last finding perhaps highlights the vulnerability of smaller organisations to cyber risk due to potential lack of awareness and detection resources. Of those sample companies that did disclose cyber-related information, we then looked at where the location of those disclosures were within the annual reports. So as I said, this is just limited to those sample companies that did actually disclose information, cyber-related information in their annual reports. So 2022 is the blue bar chart, and 2023 relates to, is in orange. As you can see, in 2022, approximately 40% of disclosing companies identified cybersecurity as either a material risk factor or a key risk, as the first two blue bars indicate. And the top orange bars indicate that this increased to nearly 50% in 2023, reflecting a growing acknowledgement, I guess, of the pervasiveness of cybersecurity risk as a material or key risk to an organisation. But that also indicates that there are half that did not of the ASX top 500. Moving down to the third line item, we can see that a large proportion of disclosing companies discuss cyber-related information in the context of their governance, outlining the importance of cyber-related governance processes and mechanisms to protect against cyber risk. We also see some of the other locations of the annual report. The director's report is well represented, and also within that the OFR. And there's a small proportion of disclosing companies that regard cybersecurity as a sustainability or ESG issue. I'll skip that one. Let's now move on to this one, which looks at, within that information that was disclosed in the context of cybersecurity, what references were made to any cyber-related frameworks, guidelines, standards or regulations, just so we can ascertain the extent of adoption and compliance by sample companies to these frameworks. And what we did is, consistent with prior studies and mindful of the Australian environment, we identified 13 cyber-related protocols that we thought were relevant, including the NIST framework, the Essential 8 maturity model, and also the ISO 27001 standard, amongst others. As you can see across both years, in the grey indicating that between 75 to 80% of companies did not reference any of the protocols. And of those cited by companies, it's the ISO 27001 standard that was most adopted, as you can see in yellow. And when I look at the interviews a little bit later, I find this finding a little bit concerning, and is perhaps at odds with investor needs, as our interviews actually revealed that investors consider the use of a standardised cyber framework as highly useful to them, as they provide an objective reference point to assess a company's cybersecurity maturity and preparedness. So that obviously forms one of our recommendations based on that finding. We then undertake analysis where we report on the blend of qualitative and quantitative information within the cyber disclosures. And so for the disclosing companies, we split them into those that provide qualitative narratives only, which is in blue, and then also qualitative narratives supported by quantitative metrics, being numerical data. And across both years, the proportions are reasonably consistent, with slightly more than half, as shown in the orange, integrating their quantitative metrics with qualitative narratives. So an extension of that is then to look at the types of quantitative metrics that were provided by the companies that provided both qualitative and quantitative information. And so there are various quantitative metrics that we used, with the top few relating to, as you can see in the first bar chart there, metrics relating to governance and policy compliance. So measurable references related to regulatory frameworks, including, say, the fines imposed by potential breaching of EU GDPR, and compliance milestones such as audit completion rates or policy adoption rates. That was the most common type of quantitative metric provided. There was also metrics related to certifications, where the number of certifications obtained or renewed was often disclosed as a quantitative metric. There was also dollar spend, not surprisingly, where amounts were reported pertaining to the monetary values of investments, budgets or cost recoveries related to cybersecurity. Impact numbers were also provided, capturing the scale of incidents in terms of affected data subjects or counts of reported events or attacks blocked. And also down towards the bottom there's some disclosure in relation to training and awareness measures, such as number of staff training completed or phishing simulation completion rates. So from our content analysis, we make the following conclusions or key summaries. Firstly, that a large minority of sample companies did not provide cybersecurity disclosures, with that proportion being higher amongst smaller sample companies. Disclosures were scattered throughout the annual report, with less than a majority of companies viewing cyber as a material business risk. We found that a vast majority did not reference any cyber-related frameworks, standards, regulations, or guidance, which would hinder investors assessing a company's cybersecurity posture. And finally, there was a small majority, just over half, who used quantitative metrics to support their qualitative narrative. And there was, as we saw earlier, perhaps a lack of consistency in the types of metrics that we used. Phase 2 of the research involved undertaking interviews with key stakeholders to get their views on what cybersecurity disclosures would be decision useful for investors. And so to do this, we undertake semi-structured interviews with investors, including institutional investor representatives, and also cybersecurity specialists, including chief information security officers. Now, we've only done 7 interviews to date, so these findings are somewhat preliminary. But the first question that we asked was whether cybersecurity information is relevant for investment purposes. And investors responded emphatically that it was critical and it was beyond important because of its connection with broader aspects of a company, including enabling assessment of the quality of an organisation's management and governance processes. So investors can utilise cybersecurity information to assess board oversight and management's preparedness against and response to cyber incidents. Cybersecurity information also enables assessment of organisational risk. So investors use cyber information for risk assessment purposes, as cybersecurity captures a range of aspects relating to a company's risk profile. And finally, information in relation to cyber incidents can be used to assess reputation and financial impact. So investors use cyber incidents and how they're publicly communicated to assess company reputation and their financial impact, including future cash flow assessments. So having established that cybersecurity information is relevant for investment purposes, let me skip that one. We ask what types of cybersecurity information is relevant. And our interview participants sort of identified 5 broad types of cybersecurity information that was relevant. The first one being information relating to the use of cybersecurity protocols. As I demonstrated earlier in the content analysis, there's not a lot of sample companies that are providing that information, but interview participants found that to be very useful. Investors prioritise assessing a company's cybersecurity maturity level and preparedness for cyber incidents with the use of a standardised framework providing an objective, well-established reference point. And while there was no consensus over which was the preferred protocol, the most common ones that were raised were the NIST framework, the ISO 27001 standard, and also the Essential 8 maturity model. So based on our content analysis, which I touched upon earlier, it may seem that investor information needs in this regard are currently not being met. Other information relating to governance processes is also deemed to be relevant. So narratives which detail governance and oversight structures at the management, risk committee or board levels demonstrate how active a company is in managing its cyber risk. Participants were also interested in information relating to future plans, resourcing and strategic goals, where statements on forward-looking strategies, future protection plans and resource commitments were considered useful. But it was noted by cybersecurity specialists that there is need to ensure that you're not too specific to avoid the information that's being disclosed being weaponised against the company. And so that's why in that last bullet point there, talk about being generic and use broad language rather than being too specific to essentially give the threat actors the keys to the kingdom, as someone mentioned it. Information relating to incident history and remediation is also relevant. So how a company handles a cyber incident is critical to assessing the quality of its governance and whether the incident has any long-term value implications. And also finally, key metrics and benchmarking were also identified as being useful so as to enable comparative analysis. So looking more closely at that aspect of key metrics and benchmarking, interview participants made the following observations in relation to that. Firstly, it's important for the benchmarking to be contextual. So as threat vectors are often industry-based, benchmarking is most valuable when done within the same industry. The interview participants also highlighted some of the quantitative KPIs that they find most relevant, and these were sort of categorised into those four categories there. Operational metrics, such as how quickly devices are patched. Incident management metrics, such as the number of incidents or threats that have occurred or been investigated or have been averted, as well as detection and recovery rates are also considered to be relevant. Staff awareness metrics, such as the frequency of internal testing, staff training completion rates, and potentially staff who opened internal phishing tests. These are of relevance to investors. And finally, resource metrics such as dollar spends on training, infrastructure, uplift programs, and even full-time staff devoted to cyber. The use of cyber frameworks I've touched upon. Investors see that as a benchmark in order to assess a company's maturity, cybersecurity maturity and preparedness. There was also comment on the need for standardised metrics because Currently, there's a lack of consistency in the definitions, the types of metrics, and also the measurement techniques that are employed. And so standardisation related to this would enhance comparative analysis. And finally, the interview participants made note of the challenges that they currently face in benchmarking. As I said, potentially because there's no generally accepted definitions or lockdown definitions or terminology in the cyberspace because it's so evolving. So, for example, what constitutes a cyber incident may vary from company to company. There was difficulty in comparing companies of different sizes because even though smaller entities may report no security incidents or no breaches, it may be due to a lack of resources and awareness rather than the fact that their cybersecurity program is actually quite strong. And also, given that benchmarks are moving relatively quickly, time series analysis is also difficult. By the time if there are metrics that are provided in the annual reports, by the time you go back and look at last year's annual reports, those measures or metrics are out of date. So there was a call for more quarterly reporting in relation to enable time series analysis. We then spoke to the interview participants about the location detail and the technicality of cybersecurity disclosures, and they made the following key observations. Regarding the location, within the annual report, investors called for consistency to aid in information processing. And given the pervasiveness of cyber risk for all organisations, investors generally called for the information to be provided in their material business risk disclosures. The information needs to be sufficiently specific to enable investors to assess a company's cybersecurity readiness and maturity, even though they did note that they didn't need the chapter and verse or the nuts and bolts of everything, but sufficiently specific to enable insights to be provided. There is a caveat to that, though, which cybersecurity specialists often raised in the interviews, and that is that there is the potential to weaponise information that's too specific. So, and finally, the investors in particular conceded that there was a presence of a knowledge gap, with a key challenge investors face when analysing cyber information is their own limited understanding. So putting that together, drawing on the preceding analysis being the content analysis and also the interviews, we make the following key recommendations to enhance cybersecurity disclosure practices. Now, firstly, given that key stakeholders consider cyber risk as a critical component of organisational risk, we call upon regulators to raise entity awareness of the pervasiveness of cybersecurity as a material business risk, hopefully seeing more disclosure of that within companies' annual reports. And also, given that investors consider it useful for companies to provide information related to the use of cybersecurity frameworks, we think best practice disclosures should contain an assessment of an entity's program relative to these established external protocols. We also call for the disclosures to contain a blend of qualitative information to enable assessment of underlying governance processes and quantitative information to enable benchmarking. But in order for that benchmarking to occur, as our fourth recommendation indicates, there needs to be some guidance to be developed on the type, definition and measurement of key metrics to enable meaningful comparative analysis. And we think this should be done on an industry basis or be industry specific, and is potentially a role that's something that regulators or policymakers such as the AASB could undertake. And then finally, it's important to note that with best practice disclosures, that the information that's being provided should protect against exposing an entity's vulnerabilities and preventing pathways for attack. That's all for the presentation, and I look forward to the ensuing discussion. Thank you. Sorry.
Thank you, Dean, for the insightful presentation. If I can now invite you to the panel table. So before we kick off the panel discussions, just a couple of things. I would like to remind everyone that the views of the panel members are personal and not the views of their organizations unless explicitly mentioned. And the second thing is we've got the QR code up on the screen. If you have any questions for the panel members, feel free to scan it and send your questions through. We'll pass it on to the moderators and the panel members. So with that, I'd like to call on the distinguished panel members. Let's start with our first panel member, Sanjay Kushu. Sanjay is an executive director and financial control at Telstra, and he is an experienced financial professional with a notable career spanning different leadership roles.
Thanks, Miguel.
Thank you. Next, we have Martin Lawrence. Martin is a director at Ownership Matters, which is an independent Australian-focused governance firm which helps financial institutions use, safeguard, and enhance their ownership rights in public companies. He's also a member of the AASB User Advisory Group. Our third panel member is Doug Niven. Doug is the current chair of the Auditing and Assurance Standards Board, and he is also the member of Australia's Financial Reporting Council, the New Zealand Auditing and Assurance Standards Board, and the IAASB, IESBA Stakeholder Advisory Council. And our final panel member is Moana Overton. Moana is a partner accounting and corporate reporting at Deloitte and a current AASB board member. With over 2 decades of experience, Moana has been with Deloitte in various technical roles in Australia, New Zealand, and the UK. With that, I'd like to introduce our moderator for this session, Dr. Sabine Schurer, who is a senior manager at the AASB. Please join me in welcoming all the panel members and the moderator. Yes.
Thank you, Mikhail, for the very nice introduction, and welcome to the stage, everybody. Thank you, Dean, for this very interesting presentation. We've heard a lot of information. There's a lot for us to unpick. And I might just, since we've heard about really who is reporting, who is not reporting, and what is being reported and what is not being reported. So what I would like to hear first, maybe from Martin, is from an investor's perspective, do the research findings align with what you are seeing and what you would ideally like to see?
Yeah, I thought it was notable in Dean's research, the comment at the end about investors acknowledging that they lack the expertise to really understand what good cybersecurity looks like. I'd say that as an investor, you are looking for a company to acknowledge it's a risk. And so that's in the material risk disclosure. And then if they have had an incident, to talk about how they have addressed it and what they've learned and what they've done. Generally speaking, the companies that have said they've had an incident have done that. I'd suggest that the companies that have done the most to talk about that are the ones that have big consumer presences where it's an incident that has affected their consumers, their customers. I was thinking of a company actually where it had a material impact on their working capital, and it was a supplier. They use an outsourced payments processing firm in the US. It was the victim of a cyber attack, and it seriously disrupted their working capital, they say, more than 12 months later. And so as an investor, what you're looking for, I think, really is an acknowledgement of the risk, some plain language disclosure of how you attempt to address it, and if you've had one, how you are responding and what you've learned.
Thank you, Martin. So then from a preparer's perspective, if I can ask Sanjay, what are some of the aspects that you tackle or consider when you're looking at the cybersecurity space?
Thanks, Sabine. Good afternoon, everyone. Look, as Mikhail said, I come from Telstra, and we have a very, very large cyber program, and it's twofold. It's to protect our consumers like any other consumer company. And I was actually interested, Dean, in your research. The materials companies seem to be quite high up. I wonder whether it's because it's quite easy for them to report against it rather than a big consumer company or a technology company. So for us, it's twofold. One is to protect our business and our operations. We intuitively, and of course, then to protect our customers, right? So I think we intuitively think of cyber risk as compromise of personal information, et cetera, but it's much bigger than that. It can disrupt organizations. I mean, if someone was to hack and control a telecom company, that's critical infrastructure. So any company that's got critical infrastructure has to think about its continuity of business, and that's a very, very big risk. So in terms of preparing ourselves and our disclosure approach, Sabine, we've been quite transparent and clear and expansive in how we talk about cyber risk in our annual report. I do feel that, and of course, internally, the governance is very strong. There's regular cyber readouts at the board risk committee, and that's been going on for years. So it seems like a recent risk, but for us, it's been quite a number of years since we've kind of been on this. So there's a lot of investment that goes on in terms of disclosure. I completely agree with the research findings. I think it's a bit ad hoc at the moment. More structure, more guidelines, and more comparability will actually help, because eventually, capital markets work on competition for capital, right? So how do you choose between company A and company B in terms of their risk profile? So it is a big topic for us. We think we're doing as much as we can. Breaches, et cetera, and communications, I think that's very important. One of the things that we don't talk about is how many attempts were made and how many attempts were stopped, right? So you might have one breach, but that might be one out of the one that was tried. Whereas another company might have one breach, but they stopped 1 million, right? And so as our chief security officer says, we need to be right all the time, but the bad actors need to be right just once. So that's kind of the environment we live in, and that's our disclosure obligation that we take very seriously.
Thank you, Sanjay. So if I can just follow up on that, if we think about reporting of risks, significant business risks, so ASIC just released in their latest financial reporting and audit oversight report that they've identified an absence of significant business risk disclosures. And Dean, you've mentioned potentially maybe a lack of awareness of those risks. Do you have any other thoughts, any other potential reasons? Is it because maybe there are no requirements?
Yeah, potentially. I was interested in the sense that, as one of the slides indicated, it was only 50% of those companies that actually disclosed cybersecurity related information acknowledged that cyber was a material or a key risk to their organisation. And so I think that gets back to just a lack of understanding of the pervasiveness of cyber risk, and a lack of awareness, and potentially a lack of resources put in place to be able to identify potential threats and to act upon those.
Yeah. Moana, what do you see from a firm's perspective in that space?
So I see ASIC has been very active over the last few years in really bringing that material business risk disclosure to the forefront of their surveillance program. And if I were to roll back 5 years, for instance, I think you would have found that below about the ASX 100, most material business risk disclosures were copied from one of the firm's models without too much change. And I think there's been a real development there of, no, actually, this is your disclosure, and we do expect you to think about it and to explain those risks and how you're managing them. I think what we do find is that the confidence that people have in making those disclosures, or entities have in making those disclosures, is really variable, because there was also that point, Dean, you made in your presentation around, if you put too much in there, you actually expose yourself to greater risk than if you'd said nothing. And that's particularly true, I think, in the cyberspace. So I think We have moved a long way, but that requirement for the disclosure of material business risks is in fact only a few words in the Corporations Act. It doesn't have a huge body of interpretive guidance or anything like that behind it. So I think there will continue to be an evolution of how people perceive that requirement and what it means in practice for what should be in their annual report. And then a reasonable amount of internal politicking for a lot of entities as well, as to not only passionately what should be there, but very passionate views about what should not be there.
Yes, exactly. I think that's a very interesting point, finding this balance, right, between the appropriate level of disclosures without jeopardizing the security and safety of the operations of the business. So Sanjay, what are some of the considerations that are preparers taking while finding this balance?
Well, that's fine balance to achieve, you know. I mean, I would respond it on the basis that we would tell the market what we are doing. We don't necessarily need to tell, we have to be careful as to what our vulnerabilities are. And look, I mean, if you think about it, if a company knew what its vulnerability is, you would expect that they would act on it, right? So therefore, the disclosure might, you know, you don't hide away from disclosure, but you sometimes disclosure obligations actually become a catalyst for action, and that's what it's the other side of the coin, right? So if we were aware of vulnerabilities in our system, we would not deal with it as a comms issue, but as a business issue, right? So then we try to deal with it as quickly as possible. So I think you should assume that a company has to be in a continuous journey, and as it identifies vulnerabilities, it kind of rectifies and mitigates it and reports against that process, rather than here's what we don't have in the business. I mean, that's not useful information.
So how do you then communicate this best to your investors and your shareholders?
Well, we do have quite detailed description in our material business risks, and it's got its own maybe a page and a half or more. The point there is not so much about our disclosure, but how do you compare within the industry and company to company, and how do you actually interpret that, right? So it's more, even for us, it's more qualitative at the moment than it is quantitative. So I'd really support the recommendation that there has to be a quantitative metric, and there have to be smart metrics that you would be able to kind of triangulate and say, well, if I add these three metrics, then that gives me a certain risk profile, right? So there has to be some structure to this kind of disclosure. It's free form at the moment. You know, we say what we think we should say, but people like Martin will tell us that, you know, you're not or are meeting my expectations. So I think a bit of structure would help.
Thank you. So moving on to the next step in disclosures and reporting, where do you think this disclosures or this information should be sitting? Because as Dean said in the research, it was spread across the annual report. So what are some of the views? Maybe Moana, I will start with you.
Sure. So, I mean, there is a requirement for the material business risk section to be complete. And another finding of ASIC over many years has been actually maybe you do have your material business risks, but they're spread out all over the report. Nobody can get to the bottom of what you're trying to say. So I think that's a logical place. And then often if you want to link that then to maybe your corporate governance disclosures or something that can provide more detail, that clear linkage between information. So, okay, I've read this about cyber in the risks, but actually if I want to better understand your governance around risks more generally, so I can think about both of those together, I actually know where to go next to find that information and start putting it together in my head.
I wonder if I could add, it's interesting in Dean's findings, I think it was about 8 or 9% of the OFRs actually had a disclosure in this area, and it was elsewhere in the annual report. And ASIC has been focusing on the OFR, and it did make me wonder how detailed you would actually expect the disclosures to be in any event, because this is one of a range of risks that a company would have. And I guess you'd have it in the OFR if it's a particular risk, a business risk, a material risk, it would be disclosed, you say, in the annual report if an incident has occurred that has some sort of financial impact. You know, loss of personal information. I know denial of service means it's affected materially the revenue. But I do wonder, to that point about disclosure, you know, helping people make a tax, I do wonder whether you'd ever have, you know, the level of detail that would actually assist someone in identifying what, you know, the particular flaw was. It could be exploited. Having said that, of course, people say, well, no matter what you do, there's going to be an event, and it's more how you manage it and how you communicate and deal with it from that point onwards. Clearly, for this loss of data, it could affect not just immediate revenue, but it could affect, as you say, reputation. Loss is already covered by Dean, by the way, and therefore could have goodwill impacts. But I have to say, as a consumer myself, if we're thinking particularly loss of personal data, I don't know how many times my data's been lost in recent years, and I'm now sort of thinking, oh, again, well, you know, does it really make a big difference? So I wonder if we're starting to get more used to it, but it might depend on the information. Yeah, if it's your address and so forth, that may be different from the actual number of your bank account, perhaps. So, yeah, it's an interesting question.
Yes, and then of course, which leads me to my next question is of how do we assure this information, right? So maybe Doug.
Okay, yes. Well, since we started with the operating and financial review, I'll start there and I'll work backwards, because the auditor doesn't have an obligation to provide assurance on the information in the operating and financial review. They read it as other information for material misstatements and material inconsistencies with the information that they do audit in the financial report. So that raises a real question as to what the auditor's actual obligations are in this area. And it may go back to the business. You know, if we're talking about someone that has a lot of personal information that's quite sensitive, then maybe that's a different situation from, well, for example, the AASB, not that we're listed. We don't have a lot of personal information, and if we lost it, apart from, you know, perhaps, you know, payroll details for employees, I don't think anyone would really care if we lost the data. So I think it does go a bit to the industry and the type of information that's held. But from an assurance point of view, the real focus is going to be where something has happened. So the concern would be an incident's occurred and it's not being reported, or perhaps it hasn't been properly assessed, you know, as to what the risks were and what the possible financial impact is on the entity, as I say, including goodwill. But beyond that, it's quite a difficult question for the auditor. You probably do some work in understanding the risks of the business. Maybe you'd look at an overview of the systems and processes, but unless something has occurred, you're probably more looking for, well, has something occurred but just not being reported? You know, there's penalties even for not reporting matters, by the way. So I think perhaps we need to be cautious about how much reliance we'd actually place on the auditors, except in those cases where an incident has actually occurred. And of course, this will perhaps evolve over time, because as we get more sustainability information, potentially, S1's voluntary at the moment. If that changed, of course, that would perhaps move the dial a bit. But at the moment, as I say, no direct assurance over the OFR, and the sustainable information that's coming is about climate. It's not about the business more generally. Obviously, the auditor needs to think about subsequent events. And I shouldn't forget APRA, because we're thinking about the financial report and sustainability report. But APRA is a regulator as well. And they have, and Dean touched on this, I saw it in one of those pie charts, that APRA has requirements, and a number of those requirements do require assurance. Maybe assurance, by the way, to APRA, not publicly, but nevertheless, that's around operational risk, resilience, and so forth. So there are other areas where the auditor may get involved, apart from special reviews where they might be engaged to do work in this area. So, and I like the comment also someone made about supply chains, because going forward, that may be something that needs to be considered as well.
Thank you, Doug. Yes.
Question for the practitioners. So I think this hasn't been tested yet, because there's a lot of attempts, but not enough successful events to test the whole system, right? For example, is a ransom tax deductible? I mean, I don't know what or if a ransom or an incident is in flight at the cutoff date, is there a contingent liability? So I don't think it's been tested to its full extent just yet.
I think that's a really fair observation, right? We just have not experienced it. We talked earlier in the day about digital and real-time reporting, and I think, you know, for an incident that's in flight at signing date, well, it probably wasn't there as the audit work was being done and the financials and annual report were being prepared. There's, you know, we don't have the systems and financial reporting in Australia, frankly, that would do a great job of capturing that and capturing it well and helpfully and in an assurable way if it's just happening in the couple of days before the financial results are announced.
Event subsequent to balance date.
Yeah, so I mean, maybe if it was on the 1st of July, you might get to something sensible by reporting mid-August. But if something goes horribly wrong on the 21st of August and you're releasing results on the 22nd,
Not a lot you can say.
there's not a lot that you can say that you would want an investor to rely on because you probably don't have time to capture all of the data and all of the information that would actually be useful and helpful.
It's also where you get to this grey area of company disclosures, because the focus of preparers is on the kind of formal documents that are assured and released, and investors place an enormous amount of reliance on these documents that live in this grey area of responsibility. So if you look at result presentations, there is now increasingly large quantities, and they're talking about management of cyber risks and attacks. All the banks now, major banks, have sections in their presentation about how much money they saved their customers this year through scam defences. The status of these types of documents has always been a little bit grey, and so the ASX did amend the rules to say someone actually has to put their name on it to say who approved this document. But in that kind of situation, investors would be expecting not so much for the financial report to reflect it, but that, and this is what has practically been the case with cyber incidents, an ASX announcement saying there has been a cyber attack. This is what we know right now.
Some of it goes, though, to disclosure around the uncertainties and the assumptions. And you remind me that not only is there periodic reporting, but there's, for the listed companies, a continuous disclosure obligation on top of any legal requirements around the disclosure. So companies are probably on a bit of a journey. You know, the events occurred, we'll tell you about this and we'll update you as occur. Don't know about the ransoms, because what we're told is, and recent case, I better not name name, is the worst thing you can do is pay a ransom. You know, perhaps it, you know, encourages other attacks, and they'll keep probably blackmailing you and seeking more ransoms. So
it is a difficult area, Doug, and I believe, and we do some simulations and real simulations where people don't know whether it's real or it's a simulation. And there are companies that have come up that actually facilitate acquisition of Bitcoin, because a company wouldn't know where to go and buy the Bitcoin. And if, for example, an airline was held hostage, it's a very tough call. I don't know what there is a legal position. I don't know what the practice is, because no one would actually admit whether they paid a ransom or not. Then the question is, if it was actually paid, where does it manifest in the financial reports, right? Is it in other expenses, or what?
Sounds like an other expense to me.
Where is it, right? So it can be a case where companies have to pay.
Well, that's right. It's one thing to not pay the ransom because, you know, my personal data will be disclosed. It's another to not pay the ransom when actually the networks that support all of our hospital healthcare systems are going to be shut down. And you can see an immediate loss of life rather than actually someone might now know my Qantas frequent flyer number. So there's a huge scale there. And then I suppose I'd love to come back to your question about the contingent liability, because I do worry about that when things happen just as we're getting close to signing, because that should be continuously updated. And the definitions are a little bit vague in terms of what's remote, what's possible. And I can see someone doing a look back test and saying, if that situation was in flight at the moment that you signed your financial statements, how on earth did you get to the view that it was remote and you didn't have to say anything in those financial statements? And absolutely, I could see that with hindsight, but in the moment when you're both trying to get a financial signed and deal with a major cyber crisis, I think it'd be really easy for that not to happen, irrespective of technical definitions, which is not a phrase I use often, just by the way.
Yeah, certainly a very complex area. And I guess one of the things that's kept on bubbling up was the link between sustainability, climate risks, and maybe some parallels with cyber risk. And maybe one consideration could be of how the cyber risks sit within the broader ESG architecture, right? Which is what some of you have hinted on. And it's surprising that only a very small percentage of your respondents sort of made that link. Yeah. Because in the climate space, we have some very concrete requirements now.
Yeah. I think, Spin, it also kind of links back to BCPs, business continuity plans. So if you put the customer side aside and then you talk about operational resiliency to deal with situations like this, what is a company's BCP, right? So you could wrap it into that and say, well, if you had a disruption due to cyber, how will you continue to operate, right? So you could wrap it up there.
Yeah, thank you very much. I'm conscious of time, so I'll move on to some of the audience questions, which are directly linked, really. So some of the audience questions relate to, should there be further standardization? And if we do have further standardization, to what extent does that make an entity more vulnerable? I might just start. So the questions were posed to Martin, Sanjay, and Moana to start with. Who would like to go first?
I mean, I'll have a crack. I think it's the kind of area where something like a ASIC regulatory guide on what good disclosure looks like is probably the best place to start, because the cybersecurity issues that confronted Telstra are very different to the cybersecurity issues that confront a junior explorer. And when Dean was sort of his 301 to 500, I was thinking there's a lot of junior explorers in there with no revenue and drilling remotely and possibly not even drilling, just putting out ASX announcements to fund a lifestyle. Their cybersecurity risks are probably lower than Telstra or Qantas but I would say just something of saying this is what good disclosure looks like, to at least give companies who don't know how to approach it a reference point. And then investors also be able to go back. And you'd need a lot of involvement from people who really know what they're talking about to make that meaningful without dangerous.
Yeah, Martin, I agree. I think a regulatory guide sort of approach would work. To come up with this standard, I don't know how we would do that, but which kind of is restricted to financial reports, but this is broader than financial reports. So an RG 230 type guidance note would help. And we do take RGs very seriously, so we treat it as law. So I hope everyone does, but that would be the approach here.
So I agree with everything that's been said. I suppose the other thing I'd add is that there's only so far you could go with standardization of such disclosures, because the risks themselves are non-standardized. Telstra isn't worrying about a plane being taken over in the sky remotely, because that's not their business risk. That's our friendly flying kangaroo. So when we think about what are the genuine cyber catastrophes that could face any company, they're quite different. And so then to the how do I manage those? How am I going to tell the story of how I manage those in a way that is helpful to investors but safe to anyone who might be affected, is actually quite a complicated story. So I could see the regulatory guide being a really helpful reference, but only taking entities so far they actually really need to understand their own risks, and then the safest and best way to tell that story.
Can I just say one of the key things I think from an investor perspective, because again, you are dealing with investors who are just not going to understand the detail. And so the only people who are going to understand detailed disclosure about cybersecurity risk are the people you don't want to understand. Is probably around who's responsible for it. And because that at least means the company has thought about who's responsible for it and where it sits. And as investing say, well, at least there's someone they can sack if it goes wrong, to be blunt.
It's an interesting analogy. You started off with sustainability. When I think about S1 and S2 and the governance disclosures there, nowhere do they talk about the effectiveness of those governance arrangements. It's just factually, what are those governance arrangements? So maybe that goes a bit to what you're saying, and perhaps it's yes about what investors want to know, but also indirectly maybe it helps drive some good behaviours.
Thank you. Yes.
By
Another-
the way,
yep.
Mo, that kangaroo talks to the air traffic control.
Yeah, I was going to say, who runs the network?
Yeah. Telstra's going to have a very long list of material business risks next year.
Another audience question that came from two independent audience members relates to the definition, I guess, of what is a material or significant business risk, and how do we avoid having a long list or litany of whatever has happened to provide some meaningful and decision useful disclosures.
Well, I think that goes really neatly to the point that Sanjay just made, right? Actually, if the major communication network of this country goes down, the possible risks are enormous in every direction that you could imagine. But if you wrote a long laundry list of those, you could certainly panic people quite effectively, but that would be all. So how do we corral that very genuine risk, not just to the entity, but to the, welfare of most Australians, to something that is, again, effective and safe to say and helpful to say to an investor?
And this goes to an interesting point too. It's materially, the risks that are material to the investors. Maybe not all investors are equal, but they're concerned about their assets and the returns. So if I use a telco example, and I'm trying to anonymise this the best I can, wasn't Telstra, but if something went wrong with the 000 number, that's really terrible because people's lives are at stake. But the financial impact on the organisation is probably hard to assess. Does it affect their business and going forward? It might not actually if they handle it properly. So that's an interesting question about materiality if you're focusing on investors rather than more social aspects of it.
Doug, it may seem that there isn't a material direct impact, but imagine the customer trust that you lose.
That's right.
And the loss of business that comes after that is tremendous. It's massive.
A very interesting discussion. So before we close this session, I would like to pose a general question to the panel members. Going forward, what do you see the role of the AASB, the regulator, and maybe also what can researchers do to support this nexus between cybersecurity, ESG, financial reporting? Maybe Dean, I'll start with you.
I think first and foremost, we just need to have a better understanding of the current landscape in relation to cybersecurity disclosure practices. This is just sort of the first sort of exploratory work that's been done that I'm aware of. And so just a better understanding as to what's being provided, and also sort of a greater understanding of whether the current information meets investor needs, I think is important. So that's where I think further work is needed. Just the general understanding of, because it is in its infancy, so just a general understanding as to what currently is being reported. I've just focused on the ASX top 500. What's the exposure of not-for-profits to cyber risk, SMEs, those types of things. These are, I think, interesting research questions that should be explored.
And I think I'd be really interested too in the question of to whom are those disclosures designed to address? So if we think about the history of ESG reporting and how that actually really got off the ground was by activist investors taking small shareholdings and making a lot of noise, to be frank, you could see that same pattern playing out here if there's a sufficient group of activists that thinks major Australian corporates are not taking cybersecurity risk seriously enough. Now, that's not to say I think those should be our audience, but it's to say that in thinking about what those disclosures should look like, we actually need to have a really clear idea in our mind as to who is the organisation obligated to in making those disclosures? And if it is society at large, that is a much bigger and different, potentially more frightening question than the sort of user perspective that probably sits in the conceptual framework at the moment.
Maybe I should, you didn't ask about assurance, but I'll answer it anyway. So the AASB does actually have a 2021 guide on cybersecurity. I have to admit, it's not in English, and we might deal with that so that people can actually understand it. But I think one of the challenges from the assurance point of view, as you probably gathered, it actually starts with the reporting requirements. And so that drives, whether it's other information or it's actually in the financial report or whatever. So they're interrelated, and you need as always, reporting and assurance parts working together.
So work towards some kind of overarching principles for disclosing what good management of this looks like and how to disclose that in a simple and safe way.
I mean, I agree with all the comments. I'll just super simplify it, tell your stakeholders what you worry about.
Yep.
So I suppose the first step is, think deeply about what you should worry about. And most companies would struggle to do that. So.
What you worry about the most.
Thank you very much. We are right on time. Thank you very much. A warm welcome. Thank you to the panel. Yes, thank you. So I will now move on. We are now moving on to the last session for the day, which is on critical perspectives, rethinking the future global reporting landscape. And as previously also announced, we would like to highlight that any views and opinions are those of the speakers and not those of their organizations. I would now like to introduce our esteemed panel, and one of the panel members is already here, Moana, and Moana thought that she didn't need an additional introduction because her personality hasn't changed in the last hour. So then I would welcome Sean Osborne. If you could please, yes, make your way to the stage. So Sean leads the accounting policy team at New South Wales Treasury, developing accounting policies and providing technical guidance and advice across the New South Wales public sector. Prior to joining New South Wales Treasury, Sean had over 25 years audit and accounting experience in the private sector in Australia and the UK. And of course, Sean is a current AASB board member with Moana. Then I would like to introduce Andrew Potter. Andrew joined Australian Foundation Investment Company, AFIC, in January 2005. He's a chartered accountant and has over 30 years of experience in accounting and financial management, again, both in the UK and in Australia. And our panel is completed by Professor Emeritus Anne Tarkar, who we've also previously introduced. So we look forward to this discussion, which will be moderated by Professor Brad Potter. Please join me in welcoming all the panel members and the moderator.
Thanks, Sabine, and thanks everyone. Welcome, panelists. We stand between you and drinks, so we are well aware of that. So we've got some questions and some things to talk about, which bring a bit of energy to the final session. So, look, the idea for this final discussion was just to have a discussion that's independent of research papers, specific issues, etc., but look a little forward. Bring a bit of Greek philosophy in there. Heraclitus, Greek philosopher. No person ever steps in the same river twice, because you're not the same person and it's not the same river. And I get that feeling that that's what we're sort of dealing with in the financial reporting landscape at the moment. There's rapidly changing environment. Users have access, or there's in fact many things taken together are contributing to that complex setting in which we prepare financial reports, and we've heard some discussion about that already. Users have access to more information about company position and financial performance than ever before. We've got publicly available databases, subscription services, etc., etc. Non-GAAP or street earnings or underlying earnings continue to be reported by firms, suggesting a persistent and increasing gap, I suppose, between statutory earnings and underlying financial performance. I'm being a bit provocative there, perhaps. Ongoing debate about the recognition and disclosure rules for key items such as intangibles and leases. We've heard a little bit about that. We might go there in the last session. We'll see how we go. Demands for real-time disclosure. We've already heard some really good stuff about digital reporting, and demands for digital reporting remain clear and strong, and ever-increasing pressures to bring more and different information into financial reports than previous. Sustainability with Scope 3 emissions as an example. Lots and lots of discussion about other intangibles that we might bring into the financials. So to have a session that sort of looks forward and thinks about or encourages us to think about, the issues and what we might sort of focus on together going forward. If our briefing session is anything to go by, like it was good, and Eric had to tell us to shut up after about an hour. So that's good. So anyway, let's get into it. So Andrew, I might start with you, if I may.
Lucky me. Thank you.
Lucky you. We are lucky to have you. So welcome.
Pleasure.
I want to ask you a question in your role as a preparer.
Yeah.
Like. So I'm interested in your views about the costs and benefits of reporting in the current environment. Just as a preface to that, we work with the Group of 100 a little bit, and we're hosting the Group of 100, which is a membership-based organisation of the CFOs of the big, many big companies in Australia. And one of the things, or two of the things that they tell us they are concerned with, is the regulatory burden brought on by more reports and that sort of thing, and this ever-present threat of or the current environment, which is prompting more forward-looking statements than ever before. So I wonder if I might encourage you to sort of reflect on either or both of those.
I suppose one of the benefits of reporting is not going to prison for not doing it. So that's an important inducement to do so. Generally, the best reporting, and it links back to something that Moana was saying, is that the best reporting comes from the demand for it, where you're meeting a demand for it. And one of the good things about the sustainability standards, apart from the fact I should say at a AASB conference how wonderfully technically they're drafted, is that this came about as a response from investors and also from companies saying there's so many differing standards out there. If we're going to have this, let's have something that we can all agree on. This is the way to do it in the future. And the sustainability standards came about as a result of that. One good thing I should note, though, another good thing I should note on the sustainability standards, and hopefully we'll see this, it doesn't just apply to listed companies. We've got to get away from the fact that more and more reporting has to be piled onto the listed companies, because you run the risk that companies and investors say, why are we bothering being listed? Let's just take it private. Because the cost has become too much on that. So with sustainability, we're seeing it's there for the private companies. It's being extended to superannuation entities. Eventually, it'll go through to government and semi-government corporations. And cybersecurity, for instance, is critical on that. I'm more worried about information at the Department of Health perhaps being leaked than I am with. I mean, as Doug alluded to, if somebody wants to see AFIC's tax cost basis by raiding our data, go ahead. It's not that exciting. So that's where the cost-benefit analysis comes from. What's actually really important to investors? What are companies and organizations being asked about when they are presenting that information and isn't already available?
Yeah, thank you. That's really insightful, actually, because one of the things that we do in research land is make some assumptions about the costs of reporting. And I don't think there's a really clear understanding about where and how those costs should be understood in light of the potential benefits for the reporting function or of the reporting function. So thank you. Sean, I might draw you in here. So where do you feel we are with regards to financial reporting in government? The reason I ask is that I sometimes feel that we necessarily equate disclosure reporting with accountability, and particularly in the government sector. I'd just be interested in whatever views you might have about how that's playing out. Where do you think we are in government reporting?
Yeah, thanks for the question.
yeah, accountability is something we talk about a lot. Not that it's unique to the public sector, but it is a specific focus. And I think what's important to understand is many jurisdictions have hundreds of different agencies, and there's also a range of different governance structures. So we've got big departments that are governed by a secretary or a director general. We have government businesses with boards where people are appointed from external to government. We have independent commissioners appointed to run agencies. And so there is a sense and an assumption that each of those individuals is operating each of those agencies with public money. And therefore each has to be accountable. And that's particularly the case where those agencies are interacting with the public. So we have some quite small agencies that regulate parts of the business community, for example. And so there's an expectation they report. At the same time, I think we've got this concern about the cost to benefit of producing all of these reports. And it's a bit of a misnomer that in the public sector, you know, if we need to do more work, we just employ more people because we don't have to worry about profit, etc. And that's just not the case. So, I mean, we've just embarked in climate reporting, and, you know, you shouldn't assume that we've just gone out and employed a whole bunch of people just to do that. So we're often absorbing this cost. So I think going forward, one of the things that will challenge the public sector is how do we maintain that accountability and the perception of accountability, but also give taxpayers bang for buck in terms of how we spend money.
Yeah, that's a great response. Thank you. And I might sort of indulge with a quick follow-up if I can.
Sure.
And that you raised the idea of benefits of reporting, and I think you know, Andrew looked at the you know, he raised this sort of usefulness for those who read it, but in government often I hear, well, the users are fairly limited, and so, you know, that detracts from the potential benefits of the exercise. But I have a view that there's a deeper element of benefits for preparing financial reports than just providing useful information to users.
Yeah, I mean, again, there's some assumptions that are made that are not necessarily all true. I mean, I think at the base, we do have investors. So all the state and federal government have unit holders and credit rating agencies who have really similar interests, I would imagine, to shareholders in terms of what they're looking at. They talk to us about the balance sheet. They go into depth about our potential liabilities and our obligations. So we do have those people. We also, of course, have citizens and parliamentarians, and particularly opposition politicians are keen to know what's in financial reports, I think. And I think it is true, though, to say that to a large extent, I think there are a lot of people who don't necessarily read the reports, but feel that it's good that those things happen. So in other words, there's a sort of there seems to be a presumption out there that the fact that you can make those disclosures and they can be audited is almost as important as the disclosures themselves. And I think that probably is perhaps a little bit different to the private sector.
Yeah.
I was actually going to note, Sean, I think it's pretty much exactly the same as the private sector, actually. Yeah. I mean, most people in this room will hear of the argument that people just don't read companies' annual reports, but it's very important that they are done, that they're audited, because it is the foundation on which people make their investment decisions, whether or not they read those reports.
I think the other thing I'd observe from the public sector experience, right, is at the deadline, hundreds of reports are lodged to Parliament all at once. And, well, you tell me if I'm wrong, Sean, but my view is that you never quite know where the media is going to pick one up and find a question to ask or an interesting observation on what the AG's had to say, or I wouldn't say that's necessarily very predictable. So you don't actually know of those hundreds of reports, which one's going to get read and interpreted rightly or wrongly.
Well, that's right. And it's also true that auditors generally, and quite rightly, have obligations that go just a touch beyond the standard audit report and key audit matters. So they have, it varies from state to state, but they have a bit more of an obligation. So their reports to Parliament are also read and questions flick back into the financial report. So I suspect there's a circle there where people listen to the Auditor General and then they go and look at the financial report. So it needs to be there, and it needs to say what it's supposed to say.
Yeah, brilliant. So I do think sometimes we have this catch-all kind of understanding and attribution of cost in inverted commas of the reporting function, and we don't fully understand the benefits, irrespective of, even though, as you quite rightly indicate, that there's a group of users who have pretty consistent information requirements, but absent of that, there's an element of discipline in preparing the information and providing the report just in case.
So, though I would argue we also don't have a full understanding of the cost.
Yeah.
So the real human costs of getting financial reports prepared, audited, and lodged wherever they need to be, private sector or public sector, on time. Yeah, the stress that you sometimes see and the people in front of you, there is a very genuine cost there that is not captured by we pay this much for accountants. And it does then have a flow-on impact to other areas of the public sector, mental health, the health system more generally. There is a real cost there. So I agree, we don't know the benefits. I would argue we also don't truly know the cost.
So I was going to preface this by saying to everyone in the audience, so if anyone's looking for a thought leadership piece or a research piece, I suspect there's going to be some ideas come out of this, this panel discussion, and I've jotted down 3 already, and I knew what we were going to be talking about. So, Moana, I might stick with you if I may. So 2 of the issues I feel have got quite a bit of momentum in financial reporting circles at the moment are the recognition and measurement of assets, and particularly perhaps intangibles, even though we've spoken about them a little bit already. I suppose the question is, where do you think we are on this, and where do you think we're heading? And if you think there's more pressing issues than sort of intangibles, feel free. But where do you think we are in terms of our understanding what the real issues are that are maybe standing in the way of progress in terms of reporting and enabling firms to communicate useful information to users?
So I think there is a huge expectation gap, right? So I did see an article, and I do see that Deloitte was referenced as the supporting reference just the other day on intangible assets and how there's 1.6 trillion of value missing from Australian balance sheets. Yeah, I saw it too, and I thought, I would probably have preferred to read that before I read it in the media, but in any event, there it is. So that's one perspective, and then we've got a regulator over here saying, well, frankly, all intangible assets are overvalued. There's more value on Australian balance sheets than ought to be there, and somehow we've got to find a path through that actually gives the information suggested to those who are concerned about the 1.6 trillion of missing value, whether it be recognised or disclosed, without undermining the very real concerns of the regulator that, well, of that 1.6 trillion, where's your audit evidence that supports that? So I think the path of the future and bringing those 2 together is going to be challenging. And I've still got a number of years to go to retirement, so I guess I'm going to be part of that.
Thank you. Anne, hello.
Hi, Brad.
So I might ask you to opine on standard setting at the moment, and I guess we'd all be interested, really. Recently finished at the AASB. You've been on the circuit a little bit, and I do know, we've swapped some ideas at various times. Be interested to hear whatever reflections you may have about where you think the standard setters are at the moment, and where, what are the challenges for standard setters right now, in your view?
I think standard setting's at a really crucial junction at the moment. We've heard a lot today about people being concerned about too much regulation or disclosure overload, the reality of the amount of work. Moana's referencing it, the amount of work that goes into financial statements. But I really love Andrew's comment that the financial statements, that financial information is fundamental, so we still need it. Is more standard setting needed at the moment? I would say if you look at the agenda of the AASB, it's sitting on 2 projects at the moment. One big one, very big one, the intangibles, that's got an enormous amount of support and demand for the information, tidying up in cash flows. There are other groups who've got things that want to be worked on. There are some smaller things being addressed, but, is there the political will, or are people standing back and saying, 20 years, all these standards have come out, we've got a solid body to work with, why don't you just retire AASB? Is that where we've arrived at? That question mark. I'm not saying it is where we are, because there are some people who genuinely want things still to happen. Investors still want something to happen on segment reporting. They've been saying that for 20 years. So they're a kind of frustrated group, those who are saying that. We're also talking about what form reporting should look like going into the future. A lot of references today have been about all the different channels that information gets out there. And we know that as standard setters, that there's a lot of ways people get information. We've also had reference to for some people, the really, really important need for the standard setters to work together. And again, Andrew referenced this already in this panel about the IASB and the ISB. Other people have said that a very clear call that it should be a joint effort around some of this information that seems to cross over boundaries. So looking ahead, I think the thing that the national standard setters and the IASB have been very good at is consultation and listening. And I would caution against people getting fatigue. What we see politically is a lot of nationalism emerging. Now, does that mean suddenly the capital markets aren't global? Does this mean suddenly that investors don't need comparability of information? I don't believe so. There's political movements happening, but that doesn't take away from the need to have a common accounting language for global capital markets. So I think we have to be patient, not to get taken up in that current wave of nationalism and drawing back and saying, oh well, we don't need global standards, and we're not putting our money where our mouth is, that kind of thing. I don't think that's helpful in terms of good information flows in capital markets, but I do think there's a way that we need to think. We just have to think about going forward, and going forward isn't going to look like the last 20 years. It's changed.
Thank you. Does anyone else want to comment on the next, what they might want to see from standard setters going forward? Feel free to dodge it or take it.
I think we are expecting more reporting demands, we all know, in terms of biodiversity, et cetera, to come out. So with all of that, I would have the premise, what's being asked for, what can be measured, what can be audited, I think is going to be critical and crucial. You can talk about a lot of what you want to do and how you're going to save the world, but let's have a focus on what can be measured and what can be audited. But I am speaking as an accountant.
Among friends.
So I guess I would add, though, to what do I want to see from standard setters. There are some really aged accounting standards still on the books. So I think in inventories, impairment, provisions, which I know is a current project, but the underlying principles have stood the test of time. But when we compare them to modern standards that perhaps provide a little bit more detail, a little bit more understanding of what the board was thinking and the basis for conclusions, which is entirely absent from the very early standards, except for changes that have been made in the last 20 years. I think there is actually a need to look at that book as a whole and say, at what point do you actually just have to say, the main problem with the standard is actually it's old, it doesn't quite explain itself the way people expect modern standards to. And so therefore the accountants that are reading it, when they have also grown up on IFRS 16 and IFRS 15, are looking at IS2 and just about going, well, sorry guys, this has told me literally nothing. And I do think there's a bridge that has to be crossed there. However slowly, I'm not in a huge great rush for it, but I do think we have to accept, as Anne said, the future is different from the past. Assuming that documents that were created many, many decades ago will stand the test of the future is probably a wild assumption, in my view.
Sean, do you want to open?
No, I do want to add. I mean, if you were to ever read some of our older standards that relate to the public sector, then they do look really dusty. I mean, they do need fixing up. But I must say, and I'm not just saying this because Anne's here, I do think overall with IFRS, we do have an amazingly robust set of standards. They make sense. And you can, when I see the things that people want changed, can I have a bit more guidance here? Can I have a few more examples? Can we deal with new assets, software as a service, AI, intangibles? It's changes in the in the environment, if you like, rather than the standards not being fit for purpose. And when I try to, in the public sector, we often have to deal with transactions that I'm sure everybody does, but we always often dealing with transactions that sit across several standards and where profit is not the key motive. So we're having to sort of reinterpret how we do all of those things, and it pretty much works.
Principles-based
principles,
standard.
they work. So I think we do have a really good set at the moment. The one thing that does concern me is volume. So to your point, if we have historical financials and then we add climate and then we add nature and biodiversity, how big do these things get? And at what point do we need some assistance in the standards as to how we cap how big these reports
One say define materiality. Go on,
is materiality 200 pages or is it 300 pages as we add these things on? So I do think we just need to be a little bit careful that we don't end up with something that's so big and so expensive that people, they're not reading it that much now maybe, but they stop reading it altogether. It becomes too big. That is a bit of a concern.
And I think, Sean, to that point, that's why we can refer back to that discussion around digital this morning, because digital's powerful and can deal with great volumes, but there's still an enormous cost before it's released for all sorts of different parties. So it isn't just, we can cope with this now. Digital can cope with volume. Well, yes, it can, but there's a whole preparation process before that needs to be looked at.
Andrew, you raised the M word, the materiality word. So the door's now officially open. So I was actually going to probe that line anyway for the whole panel about in light of all the comments. I wonder whether this might be opportune to rethink and the fit for purpose not only of some of the standards but also some of the concept and some of the guidance around some of these underlying concepts, just to clarify whether we land in exactly the same place. Materiality we love materiality.
We love materiality, and in terms of financial statements, it's fairly easy. To do, actually. You can normally work out, auditors are clear about what it is, and the educated public are clear about what it is. The real trick has now come to sustainability standards. What is material to a company for a sustainability standard? And you can say, it's something that's important to the user. Well, give me something else to go on, please. I mean, scope 3 emissions. What's sustainable? What is materiality for scope 3 emissions? How are we going to measure them? Small companies have to do an awful lot of work talking about cost-benefit analysis to be able to prove that they have no material information to report under the standards. So there's a cost-benefit question there. I'm afraid to say if the answer was simple, somebody would have thought of it yet. So this is the query. It's really not that simple. I think it's one of these things that will only come perhaps over time as more and more organizations report under it. There'll be, without becoming boilerplate, as Moana said, for a lot of disclosures, that it will become clearer what is materiality for sustainability standards. It's easier if you're a heavy emitter or a producer or something like that, but for a lot of other companies who've got to report under it, it's not that easy.
So the only thing I'd challenge there, Andrew, is I think, yes, materiality for recognition in financial statements, we're good with that. When it comes to a specific disclosure requirement, and am I going to comply with it or am I not, is that material to a user? I think we have some of the same challenges, and I'm not sure that we've found the solution there either.
Fair point.
And the example I think of is in the UK when AASB 7 came out. I remember one of the financial institutions going to the media to say this will add 100 pages to our financial report. Now, surely that information all of that detail couldn't all have been material to users, and yet there didn't seem to be a framework. It was either I tick all the boxes and therefore I must have done it right because that's what the standard says. There didn't seem to be any framework in place for how am I going to filter that to determine what.
I agree about it, because most boards, if you're in an audit committee and they'll say, well, should we leave this out because it might not be material? Go, no, stick it in. It's just, if in doubt, stick it in.
Yeah.
I think
the reporting mandate, actually, if in doubt, stick it in.
Yeah.
well, that's really illustrated by the project on climate-related and other uncertainties, the difficulties with trying to release those examples into an environment where we're working with the pre-existing definition of materiality financial statements here. The ISSB were all over those examples. So, you know, the two boards have track record of working together, but how hard was it for them to, because they're going, the examples are going into financial statements, but everyone can see it has implications for beyond that. So I think this is very germane to the issues going forward.
I do wonder, I mean, I question whether everybody does understand materiality. In our office, I coined the sort of term that's materiality is like accountants' superpower. And I think all accountants do understand materiality. They understand both the financial component and the qualitative component. But when we try to explain it to sustainability experts and climate experts and engineers and all these sorts of people, when we did our climate reports, we realized that we're not very good at explaining it. Now, we're all sitting here trying to explain things and hopefully doing a reasonably good job about it. But when we all, including myself, try to explain quantitative and qualitative aspects of materiality to non-accountants, I heard mumbo jumbo come out. And actually, so I think it is almost like a sixth sense. I think it's so ingrained in us in our training that we do get it, but I don't think we can always explain it to others that well. And this sustainability reporting, looking to the future, how does, and in the public sector, we're saying, well, how does our ability to, well, not earn money, provide services, how is that impacted? And is that one more material than this one? That when we try to explain it to the people who understood all of that information and try to work out, well, which are our 6 risks or our 8 risks and what are the main impacts, I don't know that we explained it as well as we could have done.
But also, I'd say, Sean, and you asked what else can be done. If we're making an educated guess, don't sue us if it turns out to be wrong.
I spent it was my privilege to spend some time in at University of Melbourne. I had Warren McGregor on one side of me and Kevin Stevenson on the other. And both Warren, and I saw Warren before, I think he's gone, so I can safely say this. So he was of the view that if materiality continues to be implemented in the spirit in which it was originally designed, all of this would go away. But I think with some of the examples that we're talking about now, it's a little bit more tricky than that.
Because if you think as a preparer, in my 100-page example, if I'm going to go to the directors and say, there's a list of requirements and I haven't done all of these, they're required. So they're required under accounting standards. Your job as a director is to sign off that you believe these accounts are in accordance with accounting standards. And I'm telling you I haven't done it because I think it doesn't matter. A director who's not an accountant is a little bit lost for the framework of tell me why it didn't matter. First you told me it was the rules, then you told me you didn't do it. Now I'm completely confused.
So I've got one more. I've got a question from the audience, but I've got one more question that I'll put to the panel, and then we'll go to the audience question. So I want you to now look forward. Cast your mind forward to, I don't know, 5 years, 10 years, pick a time. What does the financial reporting function look like? What are reports? Well, staying out of the weeds, I guess. What are the role of published financial reports, or what does the financial reporting function look like? Sean, do you want to go first?
What does the function look like? What are people doing in the office?
What are people doing in producing financial reports?
I love it that your people are in the office, Sean. Good job.
That's a good point too. I didn't think that we were going to go there.
60% in the office.
Well done.
So what's the process? Are we still producing financial reports in a similar way than what we're doing now?
Yeah, it's a good question. I mean, I think in terms of what I hope they're doing, I hope they're doing less reporting but better quality, and I hope that there's more commentary around that reporting and less tables and less volume. I'm the wrong person to ask in terms of what's its digital format. Yeah, I'm one of these people who's still catching up with all of that stuff, so I don't know. You know, as a government insight, the one thing I will say is that, you know, one of the things that we're very focused on, of course, is our historical reporting is almost second to our budgetary reporting. You'll remember that in governments, everyone's focused on budgets. So I'm particularly interested in forward-looking information, and I'd like to see more standards and more guidance and more protocols around how we present forward-looking information. The other thing, you know, in terms of volume of reporting, whether it's digitally or physical, and assurance, is that from a government perspective, we should be working from the basis that all the information that we gather is available to the public. So what I would hope to see is similar to sustainability, is where we can get more information, non-financial information, service performance type information out, but we don't wait for that to be perfect, and we don't wait for it to be assurance ready. So what will that mean? And when they come in on a Monday, they might do their general ledger stuff on a Monday. On a Tuesday, they're creating some commentary, auditable commentary around budget information, forward-looking information. By Thursday, they're looking at climate and nature and something else. And again, it's forward-looking.
Friday, we're ready for the weekend. Done.
Yeah, Friday, we're probably briefing ministers on what it all means. Yeah.
Thank you.
Hopefully that's some idea of the future.
Moana, the future.
Well, as someone who hasn't worked Tuesdays in 15 years, I guess I'm off the hook on the commentary. So I think the couple of things that stood out for me. So the first is a comment that was made earlier in the day about how hard it is to attract staff into the profession, or young people into the profession. I find it enormously curious that just looking around this room, it's not considered totally cool, but apparently no. So that's a real concern for me if I think about the future of our team and how we can continue to provide the high quality audits that we do. There is going to be an inherent shortage in the number of people that we have available to do that. And I think if I were to say, well, you know, what's my dream for the future, it will be that those people who want to be accountants actually have the time to do your Tuesday through Friday stuff, and the Monday of general ledger is as much automated as possible. And at the moment, you know, that's Monday to Friday for a lot of people. So that would still be a fantastic outcome. And I think, too, the other advantage I see for automation is just coming back to that real human cost of what we do. And I do take that incredibly seriously when I look around, both across our client base and across our audit partners and staff. There is a real cost of getting that information out there that has an enormous impact on the person in front of me on a day-to-day basis. And if we could take out some of that month-end peak, year-end peak, some of the stuff that actually agentic AI really can do for us and do well, I would love to believe that actually being an accountant would look more cool in 10 years' time, because actually some of the stuff that is perhaps frankly not cool is able to be done with less stress.
Great, thank you. Great point you raised too, because the job figures of vacancies available for accountants there's plenty of jobs available. And it's only recently that numbers of enrolments in the accounting course have started to bounce positively. It's an irony there that it's difficult to get your head around. So thank you. Andrew.
I would hope that what we talked about historical financial statements being simple, done according to international reporting standards with comparability, and as I said, that's a bedrock. But importantly, not to lose sight of what David Tweedy said was the whole point of IFRS in the first place, which was to allow companies to report and organizations to report their own business and their own affairs in the way that made best sense to them and to their users. And hopefully we can continue on that line.
I'd like to continue the my dream theme. So my dream, I would like to call out the educators in the room, and I'd like to see accounting being a really, really exciting course at university. I'd like all the educators to use technology, whatever they can do to make it really exciting, because people that pursue accounting as a profession, who get into it, who get deep into it, have rich and rewarding careers. So somehow we're not communicating that message in Accounting 101. And I'd like to see the whole education process change. And I think that will be driven by technological changes that are happening now. So that's my dream for the future.
I'd say, Anne, as a former medieval historian, I'd also like to see more non-relevant degrees being considered for admission to accounting firms.
UK model.
Absolutely.
I was going to ask you about your degree in medieval history, Andrew, but that's maybe a conversation.
It helped with Byzantine tax legislation.
Something that we all should know about, I suspect. So maybe just a final one. This is from a member of the audience. I was going to go with anonymous, but that would have not been a good dad joke. So apart from investors, is there another critical group or group of critical users that we should be focusing on in preparing the reports? Is it fair to say that over the next 5 to 10 years, the user profile of reports that we historically think about embedded in the conceptual framework, is there reason to rethink who they are and use that as a sort of maybe a catalyst for rethinking some of the disclosures that we produce? Any thoughts? Anyone on the?
I'll stick to a public sector perspective because then my colleagues get something to say as well. But for us, it's now it's citizens and parliamentarians, because obviously they are representatives of the citizens. So we think about that quite a lot and quite overtly. I think in future, and this is the challenge with sustainability information, and forward-looking information, is who else that draws in, what other groups of the citizenry begin to get pulled into needing information. And one thing that I think we do have that is a bit unique is that the public sector needs to think about whether some of this information is focused on the outward impacts. What's the impact of our legislation and our policies on the environment and households and businesses, for example, with climate? And if we move into that space, then of course the user groups or those other users, so citizens, users, the community, they're paying much more attention than they are now.
Okay. Anyone else want to?
Sure. So I guess I have enjoyed the motivational chat about how no one reads financial reports anyway. That's.
I speak as somebody who writes them.
But I suppose it's a really interesting perspective, right? So particularly when AASB 1056 came out, the superannuation standard, I don't know how many people in this room have read the financial report of their superannuation fund recently, but I think we've all probably read our individual superannuation statements, right? So it's a great example of actually that has to be there to support that. But our anticipated users being the investors, you and me, all investing in super funds in Australia because we have to, it's actually not the same, right? And then if we think to the Gina, can't say that word, forget it, New Zealand accent, moving on. What's behind the climate reporting and those types of things, it is from pressure largely from people who originally were not in our main user groups, but felt that their message, what they wanted to hear, was so important, they needed to get themselves a voice at the table and force that to come through. And so I don't think that trend's going away. I think that actually, people do have expectations of corporate Australia that whether I invest in you or whether I don't, actually I have a right to expect that you'll behave in a certain way, that you'll report in a certain way, and that you'll be held accountable for that. And I think, as I said in the earlier session, that's a little bit of a scary thought, but it's kind of a valid one as well. So.
Oh, I agree. And I think that's why it's so important that that focus in the future continues to expand to superannuation firms and the businesses they have bought, because they do affect all stakeholders. Just because you're owned by a superannuation firm doesn't mean you haven't got customers and other stakeholders. And also, what you're saying about government, I quite agree. That's important. And the other answer to the question, it was going to be flippant, but I was going to say class action lawyers always need to be considered when writing statements. But actually, it does make sense because as a director, as a repairer, you should be looking at these saying, is the information that I've got in there correct? Can I back up that information? And does it explain clearly what we're doing? Does it say what we're doing and why we're doing it? So do bear that in mind.
The investors are powerful, the money moves. It's really important having this investor focus. And you can see how certain bodies have struggled when you take it away from the investor focus. So investor focus will be there, the way of producing information that's relevant to the investors, and we can have transparency around that, we can have accountability. We still have to think about the motivations of people. That's not going away in the future. People will still be making decisions, self-interested or not. But what we have seen is greater recognition of other parties. We've seen the AASB and the AASB settle on investors as the focus, and we've seen other parties really develop their work around a broader group. So the group that was previously called GRI, those people, plus the EU approach was broader. So I don't think that's going to change. But as we approach it, while we maintain that the financial information is fundamentally important, to have the primary focus there on the investors helps that happen. And there will be information provided wider and for broader, but I think in terms of the basic financial information we're reporting, having investor as the group that the information is prepared for facilitates the process. And that's really important when we talk about not wanting to expand the financial reporting to such a level that we lose the information and incur excessive cost. Thank you.
Okay, look, unfortunately we're out of time. So thank you very much, panelists. Please join with me, folks, in thanking the panelists for another wonderful discussion. So invite Sabina, Eric up to close the festivity. Thank you.
Thank you for the panel discussion. That was wonderful. Lots of great messages in there. Look, it's now almost at the end of the day. I'm glad that you all stayed until the end of the day. It's been a long day for everyone. We're going to close the session by first, let me introduce, we have introduced already. Let me invite our chair to do a closing remark, and then I'm going to invite Professor Brad Porter to do the closing remark as well.
Well, I'm very conscious that, myself and Brad are standing between everyone and the drink session, so I won't be very long. Thank you very much for everyone turning up today. Today was a very successful event, some very interesting papers presented and a lot of very informative and interesting discussion. I think a lot of us, I know I can speaking for myself, a lot to take away from today, and I hope all of you are in the same boat there. Just a quick plug, tomorrow we've got our Sustainability Research Forum as well, and also on Wednesday we've got our Applied Research Day where we showcase a number of projects that we've funded during the year. So hopefully I'll see most, if not all of you, tomorrow and Wednesday as well. So thank you very much for attending. I'll hand over to Brad now to close things out. Thanks all.
Thanks, Keith, and thanks everyone. Look, just personally, thanks to the AASB for enabling us to participate in the day. We're very grateful for that. Thanks everyone for the energy in the room. I do really believe that this is an opportunity that we have to talk to people about things that you might do going forward. If this is a once-off and we get together once a year, that's great, and it's once a year one more time per year that we didn't used to get together. But there are bigger things to do. The environment that we are working in is rapidly changing, and it takes all of us. There's an opportunity for us all to get together and think differently how we might collaborate going forward. I look forward to the opportunity. Look forward to meeting as many of you over the next few days that I haven't already met, and talking to some old friends again. So thanks again, and see you tomorrow.